don't be shocked if you in the next 6 months after that breakout, meaning sometime in the second quarter, that silver has a move comparable in dimension to the prior ones. And I think on a ratio scale, it wouldn't shock me that you even saw 500. During that chart starts at 75 and up through the present. And in fact, I think maybe that punch out above the highs is a little bit higher now, but this is a logarithmic scale chart, ratio scale. So from the bottom of that range, Vince was talking about buying silver at 4.5. He was down at the bottom of that range when he was buying it, by the way. That range goes from about $4 lows to $50 highs, and it stayed there for 50 years, half a century. Okay. But silver now says, hey, I'm out of here. Okay. I'm tired of this. I shouldn't have been here this long. And when you make a mistake of overpricing, or in this case, underpricing for so long, when you finally correct the mistake, quite often the market in question overdoes it. So in other words, if silver ought to be, let's say, a couple $100 an ounce, just to catch up with the decay in the money unit, it'll probably overshoot that. And likely it's going to do it in a matter of a couple quarters, just like copper did, just like lead did, and other markets as well. I could have used other examples. But when you put silver on an arithmetic scale like you're looking here, it says, hey, I got a tenfold move from the bottom of that range to the top of the range, right? Okay, well, if I do the same thing again, and I have a $50 range, arithmetic now, I'll go to 100. So no doubt there's going to be some guys who use arithmetic charts who say, okay, we've met our swing objective. The problem is when you put it on a ratio scale, you could go to 500. Because this range you're looking at there was a tenfold from bottom to top. If we have a tenfold after the breakout above 50, that's $500. This is a fresh breakout. If this were a price chart, you wouldn't be assuming there's a top coming real soon, considering you just broke out of an 11-year wide base. And gold spread versus S&P is even more flat, more definable. And it just broke out. Yeah, well, the gold S&P. It hasn't gone as far as silver, but it clearly broke out in November, went further in December, and has gone further since. But look at that base. If that were a price chart, what would you say? Oh, I got to buy that guy, right? It's a fresh breakout.
Definitely. Very
We're
not.
not at the end of something, okay?
Michael Oliver reveals silver's 50-year breakout signals a historic surge, potentially to $500 within 6 months, as momentum patterns mirror copper's 400% rise. Vince Lanci confirms a physical shortage crisis, with industrial demand clashing against manipulated paper markets.
The correlation, the dollar, by the way, dollar right now is trading around 98, dollar index, excuse me. You go back to 2015 low in price of the gold, that would be when that surge occurred in 2015 that got up near 100. Okay. Actually, the close of 2015, which was the monthly low close for gold, dollar index was around 98. Dollar index is right now, 10 years later, at 98. If I used the dollar index as my rationale for buying or not buying gold, I wouldn't have bought gold. Okay. Right. Gold's up fourfold, dollar's gone sideways for a decade. The price chart you're looking at there on the dollar index, by the way, is hugging an idiot line that any guy with a crayon or a 3-year-old with a crayon or a ruler could have drawn, okay? So they're buying it on that trend line for what, about 6, 7 months now. Every time they rally, they just loop right back down to the line. Momentum, however, says, no, you blew your structure, guy. You're not going to hold. Momentum usually leads price, and right now momentum blew out a trend line going back to 2008. Okay, multi-point uptrend, blew the heck out of it, and is just hovering there below the breakage. So the dollar, as far as we're assessing, is in a bear market, and the real price consequence is yet to be seen. But when it does, that'll even impact what we're talking about in other markets even more so.
For example, gold. The dollar is up, so gold should be down. And those started to deteriorate, and those correlations were something that I was as a paranoid gold bull. I'm like, all right, when are they going to snap back into place? And they would snap back into place for days.
Same situation you got with T-bonds, by the way, the long-term government debt. Well, that's a 10-year average of the dollar index. It also broke a 10-year average as the metric. It also broke its uptrend. There's another market, and that's long-term government debt. If you could scroll over to the right a little more to show what's going on now, just a bit more.
This is as far as
Okay, you're up to date. That's good enough. It's the end of December. We're still where we were then. In fact, we're slightly lower than the price at the close of December. T-bond futures trading right now 115. You see the circle price there in 2022? Since September or as October of 2022, bonds had collapsed. Yields had exploded on the 30-year end.
They expose the collapsing dollar, failing bonds, and the AI bubble's imminent pop as catalysts that will force a violent rotation into real assets, marking the end of financialization and the dawn of a new monetary reality for silver.
But it's even more obvious in silver because we see the shortfall of metal, the lack of, you can get all the gold you want. I mean, I'm not saying it won't be higher, but it's out there. But the silver is spoken for. The silver is used industrially. So when you take the concept I'm talking about of correlations no longer working for physical assets, where people will say, in energy, will say, I want the molecules. I don't care about the price, right? Well, now they want the atoms. And so when you look at this chart, it's the death of financialization of silver. That's what you're looking at there. You're looking at people who used to be comfortable saying, oh, it never gets this far out of whack with the S&P, to now saying, oh, shit, maybe I need to get some silver.
This is a very important chart. These spread charts are. Spread means the ratio of silver. Here's the S&P, for example. Silver is stuck in a range from 2014 to the present on either side of 0.8%. Suddenly, there's going to be this country, that country, this country, more countries, not us, will be the laggard, that say, okay, gold's money again. Okay, we're not, the fiat money didn't work. We've had it for like 100 years. And look what's happened. Look at Japan. Look at the UK. Look at their debt markets. It's not just our bonds. It's not a mortgage crisis this time. It's a treasury bond crisis. And there are some stock sectors that are ready to puke in a big way with this. I would particularly be watching such ETFs as RWR, which is a commercial real estate. It is very anemic. It looks sick. And it looks like when those T-bonds go, you're going to have a lot of defaults in the commercial real estate area. Big defaults.
Out of AI, just use it. Let's pretend it's only AI and miners. In the beginning, Wall Street style, which Michael has experience with more than me, and I do as well, it'll be a rotation of notional. Interest rates are going to zero. Oh shit, I'll put more money in miners and I'll put some money in gold. And what it'll happen is like there's two words that you're looking for. When people rotate out of one asset class into another, there's notional, I'm moving 100 grand from here to here, and there's degrossing. And degrossing is when I have $100,000 in money here, I'm going to buy the same number of shares there and put the rest in cash.
That's when the data points suddenly go super dark. They're already sort of gray right now, the Fed acknowledge that. But I'm talking about go super dark and we acknowledge, oh, we're in a recession or worse. And don't be surprised by or worse. And it won't just be us. It'll be global.
And by the government, I mean everyone. Anyone who's got their finger on a lever over there recognizes that we are in what's called a pot odd situation. We're printing, and if we stop printing, it'll collapse. The velocity of money is very important. Mm-hmm. And I believe that they have all decided, at least in the West, to tolerate higher gold and silver, higher gold prices. They have no control over silver. They're tolerating higher gold prices. They're tolerating gold making new highs while they're easing, as long as oil doesn't go up. They're looking at it as, okay, we have to put up with high gold prices now. We can always blame it on China. But as long as oil stays down, we need to do this because the economy is spinning its wheels. If AI collapses, all that money's going to go into gold. All that money's going to, some will go into bonds maybe, some will go into silver, but all that money's going to go on the sidelines. That's actually happening now. And I people, my age and older understand this, but people my age and younger don't. And that is that there will be a wholesale zeitgeist change in mind. And the institutionalization won't just be everyone saying, let's go out and buy it. It'll be insurance companies that are buying it, which they are in China. It'll be states in the U.S. saying it's legal tender. It'll be pensions.
Funds.
I'm sorry, what?
Pension funds.
Pension funds, right. It'll be banks like Goldman Sachs and JP Morgan for the last year saying you should start putting some money into gold. And institutionalized means passive, have to buy it, all the time. A portion of my portfolio must be in it, and we can't afford to not own it anymore. And you're going to have, unfortunately, the same mindset in passive investing that we're seeing in tech stocks eventually come to precious metals.
You've had three up waves of rally effort, rally effort, rally effort, and all you've done on price is go sideways. It couldn't get off the mat. Okay. Three is usually all you get. If you can't get it going after three attempts, watch out. Well, look at the structure on the momentum chart. There's two trend lines, one through closes, one through lows, going back what? Over 3 years. And you're nestled right on top of it right now. You drop the T-bonds about 4 points down to about 111, which doesn't blow out the recent price lows, which are down at 110. And that momentum chart says you're gone. That's when the Fed goes ape. And already President Williams of the New York Fed over a month ago said the U.S., quote, is going to, quote, buy bonds. Okay. And his reason was not that they need support, which they do, but liquidity. A nice, comfy excuse. Okay. Well, they've been buying bonds for a couple months and they can't get it off the mat. And I'll tell you what, when that dollar index starts to slip a bit more, and regain the downside, which it's already in, you start breaking that beast down through that idiot trend line, and you break those T-bonds back down about 4 points from where they are now, and you're going to start to have headlines out of these two massive asset categories that will impact lots of stuff. And, as Vince said, in the past, asset flow goes out of the stocks, but it doesn't go out of everything. You can go look at what happened to gold between 2000 and 2002. It bottomed. It moved up. Stock market got cut in half. NASDAQ 100 went down 82%. Okay. And then again in 2007 through 2009 low, gold advanced during that time. Yes, with a jiggle in 2008, but still in an uptrend. 2000 to 2002, there wasn't a crash. But the NASDAQ 100 dropped 82%. Okay, wiped out. S&P didn't really have a crash then. A crash being an event that occurs over several weeks and is at least 30+%. Okay, 29 crash is a crash. 87 was a crash. Even the April drop we just had in the stock market here. If you look at an S&P chart in January to February, it was at 6,200 almost. It collapsed to 4,800, much of that in March, April. Take a look at a gold chart at the same time, it was going straight up. Because so even with a 20% drop in the S&P, much of it compressed in a handful of weeks, March, April, gold was going up the whole time. So the people who thought, oh, well, gold's got to go down too, or silver, no, they didn't. Okay. I don't think we get a sharp break in the stock market till S&P works its way back down around 5,600 sometime this year. At that point, maybe you put your helmet on. And maybe at that point, gold and silver will be at levels where they say, hey, we can have a correction. Silver's $300-400 or whatever, or gold's at the minimum eightfold move at 8,000. You get my point? So if you're long now, focus on gold and silver. The stock market is unlikely to have a collapse anytime in the next handful of months. It could work lower. Frankly, we think it's going up for another month or so. But I don't think gold and silver are going to be intimidated by that. And when they do get intimidated, if they do, and that correlation is not good, by the way, stock market sell-offs and gold sell-offs. 87 crash, stock market crashed in 2 weeks. Gold went up there in that month, was 7% up month. Okay. But anyway, if you're long, blank out the day-to-day headlines and focus on the move to a new reality in silver.